Imagine if you could find some kind of hidden code, right? In the middle of all that chaos in the financial markets. What if you could predict reversals with, well, surprising accuracy?
That's a compelling idea.
And what if the secret isn't some super complex algorithm, but maybe these, I don't know, almost ancient mathematical patterns, patterns you see in nature, maybe even in us?
That's precisely the territory we're exploring today.
Welcome to the deep dive. Today, we're really plunging into something fascinating, harmonic patterns in financial trading.
Hmm.
And these aren't just, abstract concepts. They're meant to be precise geometric structures that traders actually use to try and anticipate these big market turning points.
That's right. And our mission today is really to boil down the essence of quite a lot of complex material on these patterns. We
Mhm.
want to get into the intricate rules, the specific math behind them.
Sort of a shortcut through the jargon.
Exactly. A shortcut to understanding a pretty sophisticated part of technical analysis.
Which, leads us straight to some big questions traders have always asked. Like, what if all that randomness we think we see in the market actually has a hidden rhythm, a geometric one?
Uh-huh.
And crucially, could understanding that rhythm actually give you an edge, maybe even a significant one?
It's the million-dollar question, isn't it?
Mm,
Are these patterns genuinely reflecting something deep about market psychology? Or are they perhaps just a complex way of finding shapes after the fact? Seeing patterns in randomness.
right, the hindsight bias problem.
Precisely. And even if they are predictive, how do traders realistically apply these incredibly precise mathematical rules in the messy, real-time world of trading? That's the practical challenge.
Okay, let's start to unpack this then. When we talk harmonic patterns, we're looking at geometric shapes on price charts, right?
Correct.
And they lean really heavily on Fibonacci ratios to project where prices might go next.
That's the absolute key. They're not just random shapes you spot. They're defined by very specific Fibonacci relationships between different points in the pattern.
And these points, they're labeled X, A, B, C, D.
Typically, yes. Think of X to A as the initial major price swing, the first big move. Then B is a retracement of that XA leg.
A pullback.
Exactly, a pullback. C is then a move against the AB leg, sort of a counter retracement. And DD is the big one. That's the calculated completion point, the potential reversal zone, or PRZ as it's often called.
PRZ, potential reversal zone. Okay, so you identify X, A, B, C, calculate D based on specific rules, and that's where you expect the price to turn.
That's the core idea. And these patterns can predict both moves up and moves down.
Ah, so bullish and bearish versions.
Precisely. A bullish pattern suggests the price might be about to move up, so maybe a buying opportunity. A bearish pattern flags a potential downward move, maybe a chance to sell or short. The whole goal is identifying these high probability reversal zones.
And Fibonacci is the engine driving this calculation. We hear that term a lot. Remind us quickly why those numbers 0, 1, 1, 2, 3, 5, 8, and so on are so important here.
It's fascinating, really. When you take ratios between numbers in that sequence, you get these specific values like 0.618, 0.786, 1.27, 1.618, the golden ratios.
Right.
And these ratios just seem to appear everywhere in nature, art, architecture, and proponents argue in the collective psychology driving financial markets. The idea is they reflect how far humans, collectively, tend to push prices or let them pull back before changing direction.
So that's where retracement and extension come in. We'll hear those a lot.
Absolutely. A retracement is just a temporary pullback against the main trend.
Yeah.
Price goes up, pulls back a bit, that's a retracement. An extension, on the other hand, is when the price pushes beyond a previous high or low.
Okay.
Harmonic patterns use Fibonacci levels to predict the exact expected depth of these retracements and the length of the extensions. It's about quantifying those movements.
Okay, this is where it gets really, really specific, isn't it? Because the source material details several distinct harmonic patterns, each with its own unique blueprint.
Exactly. Each pattern has its own set of non-negotiable Fibonacci ratios that define its structure and therefore its potential reversal point. Let's walk through the main ones.
All right.
We should probably start with the simplest, the foundation, the ABCD pattern.
Okay.
This is really the building block. It's basically two price legs back to back that are equal in length, sometimes equal in time too, but the length is key.
So like a zigzag, price moves from A to B, pulls back from B to C, then moves again from C to D, and that CD leg is the same size as the initial AB leg.
Pretty much, yes. It's like a basic rhythm or symmetry in the market's movement. C should be a specific Fibonacci retracement of AB, and D is then projected from C, often hitting levels like 100%, 127%, or 161.8% of the BC leg. But the defining characteristic is that the price distance of CD equals the distance of AB.
Simple idea, but powerful if that symmetry holds.
Oh,
Bullish and bearish versions.
both. A bullish ADCD points upwards at D. A bearish one points downwards. It's foundational.
Okay, what's next? Something more complex.
Let's look at the butterfly pattern. This one is known for signaling potentially strong reversals because its D point, the completion point,
Yeah.
actually extends beyond the starting point of the whole pattern, beyond X.
Whoa, so the pattern makes a new extreme high or low before it reverses.
Exactly. It implies the market sort of overshot itself. Key ratios here. The B point must touch the 78.6% retracement of the initial XA leg. That's very specific. And the D point typically extends that XA leg by 127% or 161.8%. That deep extension beyond X is the butterfly signature.
A 78.6% B point and a D beyond X. Got it. Sounds dramatic.
It often precedes a significant reversal. Then you have the crab pattern. Think even more extreme.
More extreme than the butterfly.
Oh, yes. The crab is famous for its massive D-point extension beyond X. We're talking 161.8% of XA, sometimes even way out at 224% or 361.8%.
Wow. That sounds like the market is really stretching like an elastic band about to snap back hard.
That's the perfect analogy. The B-point retracement for the crab is usually shallower, maybe 38.2% to 61.8% of XA, but then that D-point just explodes outwards. It suggests a market that's gone too far too fast, setting up for a potentially sharp, violent reversal.
Okay, crab equals extreme stretch and snapback potential. What else?
Let's bring it back a bit with the bat pattern. This one's generally more compact. Its D-point completes within the initial XA leg. It doesn't extend beyond X.
So a shallower reversal is expected, maybe?
Often, yes, or perhaps just a more contained one. The key ratios for the bat are a B-point retracement of XA that hits the 38.2% or 50% level, and crucially, the D-point completion is at the 88.6% retracement of that initial XA leg.
88.6%. That's very precise. Not 78.6%, not 100%, but 88.6%.
Extremely precise. That 88.6% D-point is the defining feature of the bat pattern. It suggests a specific kind of pullback before the trend potentially resumes or reverses more modestly.
Okay, bat is compact, D inside X, 88.6% retracement. What's the last main one?
We have to talk about the Gartley pattern. This is one of the oldest, described by H.M. Gartley back in the 1930s. Some traders call it the king of harmonics because of its history and perceived reliability.
The king, huh? What makes it special?
Its structure is very classic. The B point must retrace the XA leg by exactly 61.8%. Not 50%, not 78.6%, but 61.8%. And the D point, the reversal zone, lands precisely at the 78.6% retracement of that same XA leg.
Okay, so Gartley equals 61.8% B point and a 78.6% D point, both retracements of the initial XA move.
Exactly. That specific combination, 61.8% at B and 78.6% at D, is the Gartley signature. It's seen as a very balanced, reliable structure pointing to a high probability reversal.
Fascinating. That's a lot of specific rules and numbers for each pattern. And you said the source mentions others too, like 3 drives or 5-0.
Yes, there's a whole family of these patterns, but those 5, A, B, C, D, butterfly, crab, bat, and Gartley, are really the core ones most harmonic traders focus on. You know, this idea of finding repeatable, precise patterns in complex data, it actually reminds me of a deep dive we did previously on advanced data visualization and how identifying underlying structures can give you insights.
Right. There's definitely a connection there in the methodology, finding signals in the noise.
Exactly.
Now, understanding these intricate patterns clearly takes more than just knowing the names and ratios. It needs the right tools, a lot of practice, and, frankly, a reliable place to even apply this knowledge.
That's a very important point.
And speaking of which, we know navigating the world of online trading platforms can be tricky. There's unfortunately a lot of unreliable stuff out there, platforms that aren't really about genuine trading or investment. So we've looked into this and wanted to highlight a platform we believe stands out. It's secure, it's global, and it's widely considered a top-tier choice for investment. You can trade stocks, gold, forex pairs, lots of different markets.
And reliability in execution and access is crucial for this kind of trading.
Absolutely. Plus, they're known for being really fast with deposits and withdrawals, which is always a plus. And as a special offer for you listening, you can get a 50% bonus on your first deposit. We've put the link right there in the description below.
That's worth checking out if you're looking for a solid platform.
And, if you're feeling inspired by this discussion and want to really build a strong foundation in trading and investment, maybe starting from scratch.
It's a serious undertaking.
It is. We also wanted to mention a professional course designed for exactly that purpose. It takes you through everything step by step in a really structured way. We've included the link for that course in the description as well. Definitely something to consider if you want to go deeper.
So, assuming someone has identified one of these patterns correctly, With all the specific ratios lining up,
Hmm.
what then? How does it translate into an actual trading decision?
Right, the practical application.
Well, the whole point, as we said, is to identify that D point, the potential reversal zone. That's where the trader starts looking for an entry. If it's a bullish pattern completing at D, they might look to buy. If it's bearish, they might look to sell or short sell.
But you wouldn't just blindly jump in the second the price hits that exact D point number, would you?
Absolutely not. Or at least that would be very risky. Remember, these are potential reversal zones. It's all about probabilities, not certainties.
Okay, so it's not a crystal ball.
Definitely not. Successful harmonic trading relies heavily on confirmation. You wait for the pattern to complete near the D point, and then you look for other signals to confirm that a reversal is actually starting to happen.
Like what kind of signals?
Things like specific candlestick patterns appearing in the reversal zone, maybe divergence on an oscillator like the RSI or MACD,
Yeah.
perhaps a sudden increase in volume. You need other technical evidence to support the harmonic pattern signal.
So the pattern tells you where and when to look, but you need other tools to confirm if the reversal is actually happening.
Perfectly put.
Yep.
And it requires immense patience waiting for the pattern to fully form, waiting for the price to reach the PRZ, and waiting for confirmation.
Yeah.
Plus, strict risk management is non-negotiable. You always need a stop-loss order in place in case the pattern fails, because they do fail sometimes.
That brings up a really important practical point you touched on earlier. Markets aren't perfect textbook examples. What about the precision? If a Gartley needs a perfect 78.6% D point, but the price only hits, say, 78.0% or maybe 79.0%, does that kill the pattern? How do you handle that?
That's a fantastic question, and it's where the art meets the science. You're right, markets are messy. They rarely hit these Fibonacci levels to the exact decimal point.
So,
So experienced traders work with tolerance zones, or slightly wider potential reversal zones, around the ideal Fibonacci levels. A small deviation doesn't necessarily invalidate the pattern.
how small is small?
Well, there's no universal rule, unfortunately. It depends on the market, the time frame, the specific pattern, and the trader's own testing and experience. Some might allow a few percentage points or a certain number of price ticks around the ideal level.
Okay.
The key is looking for confluence within that zone. Does the price stall there? Do other confirmation signals appear within that slightly wider area around the D point? It's about understanding the spirit of the pattern, the underlying exhaustion or potential turn, rather than being rigidly fixated on the absolute mathematical perfection. It demands flexibility alongside precision.
Wow. Okay, that makes sense. It's precise, but requires interpretation. What an incredible journey into this idea of structured chaos in the markets. We've really only skimmed the surface, but it's fascinating how these geometric patterns offer such a different way to look at price movements.
It really is. Trying to quantify market psychology, collective human behavior, using these mathematical ratios derived from nature, it's a concept that's constantly being refined and debated, actually.
It feels like trying to find the underlying rhythm beneath the noise.
That's a good way to put it. Finding order where initially it just looks like random fluctuations. And maybe, just maybe, it hints at something deeper about how predictable we are collectively, even in complex systems.
Which leads to a provocative thought, doesn't it? If these patterns do reflect market psychology, fear, greed, indecision, what does their mathematical predictability tell us about human behavior itself? Are our collective actions driven by emotion, somehow more patterned, more harmonic than we usually think?
A profound question. And it sparks a few more for you, our listener, to maybe ponder.
First, given the almost uncanny precision these patterns sometimes require, does their potential success suggest a kind of deep, almost universal predictability in complex systems? Or is it simply a very refined way of tracking and reacting to collective human herding behavior in markets?
Second, how does this highly structured geometric approach to market analysis sit alongside, or maybe clash with, your own understanding of how things like economic news, company earnings, or general market sentiment drive prices? Can they coexist?
And third, stepping back from finance for a moment, where else in your own life or in the world around you could applying a disciplined mindset focused on recognizing underlying patterns, even subtle ones, unlock some unexpected insights or lead to better decisions.
Food for thought, definitely.
Absolutely. Well, if you enjoyed this deep dive into harmonic patterns and you want to keep exploring these kinds of complex topics with us, please do make sure you subscribe to the channel.
It helps us keep bringing you this content.
It does. And as we mentioned, you'll find links below for the sources we drew from, the platform, the course, and other resources if you want to dig even deeper.
Yes, we've put several important links down there in the description. We really do recommend checking them out. They provide a lot more context and detail.
And we genuinely want to know what fascinates you. If there's a specific area, a complex topic, anything you'd like us to tackle in a future deep dive, please let us know in the comment section below. We do read them.
Your suggestions often shape our future explorations. And don't forget, you can find our previous deep dives covering other aspects of market analysis, decision-making, and much more in our archives. Stay tuned for upcoming episodes too, where we'll continue uncovering surprising insights.
Thanks so much for joining us on this deep dive. Until next time, keep digging for knowledge.